Good morning. The clean exit, structuring loans with the end in mind. And most borrowers focus on one thing when getting a mortgage, and that's the interest rate. And smart borrowers focus on something else entirely and how they're getting out of the loan when the time's up. So, whether you're buying a home, refinancing, or financing a business property, the cleanest exits are created at the beginning and not at the sale table. And loan structure decisions made today can either protect your future flexibility or quietly box you in. And this is where strategic loan planning separates an advisor from a transactional broker. So let's talk about what is a clean exit in lending. Well, a clean exit means you can sell, refinance, or transfer a property without friction at the time of your choosing, without penalties or surprises. And what that accounts for is your likely hold period, market rate cycles, sale or refinance timing, buyer financing options at that time when you're going to sell, but also cash flow during your ownership period. And the goal isn't just approval today, it's optionality later. All right, so prepayment terms, number one reason, silent profit killers. So prepayment penalties are common in commercial loans and increasingly relevant in certain residential products, especially DSCR financing. So what you got to watch for, there's often a lot of step down prepays. So a 5, 4, 3, 2, 1 after the fifth year, you're free. But then if you go into other products, there's yield maintenance, defeasance, lockout periods. And if you plan to sell or refinance within 3 to 7 years, the wrong prepay structure is going to cost tens or even hundreds of thousands of dollars at your exit. So a clean exit strategy aligns prepay terms with your realistic hold period and not the lender's preference. Number two is assumability, a hidden exit advantage. Having an assumable loan can materially increase your property's resale value, especially in a rising interest rate environment. So why does that matter? Well, buyers can assume your lower rate loan, when rates available are higher, and it reduces buyer financing friction. But it also expands your buyer pool. And with lower interest rate financing, it can support a higher sale price as well. And assumability is often overlooked but in certain deals, it becomes a strategic asset and not a footnote of the process. So, third reason, loan term versus your hold strategy. And you need to match your loan term to your hold strategy is the point here. It's critical. So, an example, if you're getting a 5 year loan for a 10-year hold, you've got about 5 years of adjustable payments to worry about. Or a 30-year fixed for a 3 year flip, it seems like you may be overkilling that. But a short-term bridge without an exit refi plan, just dangerous. And a clean exit is going to consider your balloon risk when your term's up, your refinance windows, what rates will look like then. Reset exposure is the same thing, but also market timing. Rates may be different whenever you sell. So this is where many borrowers get trapped, and not because the loan was bad, but because it wasn't aligned with their exit strategy is the real point. Number four is selling a home or business later starts now. And if you expect to be able to sell a business with real estate or transition from an owner user to an investor, or if you want to trade up properties, or if you want to execute a 1031 exchange, or even if you're just doing a cash out, a strategic cash out, your loan structure has to support that outcome, is the point. And great exits are engineered, not improvised. So, why does this approach work? Well, transactional brokers sell rates, and strategic advisors are here to design outcomes with your best interest in mind. And you have to think about the end at the beginning, is the point. And this will reduce your exit friction. It'll preserve your optionality for going a couple directions, but it also protects your equity and improves your long term returns. So, this is how disciplined borrowers win across market cycles. And here's the final thought for the day. And the best loan isn't the one with the lowest rate. It's the one that lets you move cleanly and profitably when opportunity knocks. So if you want your financing structured with the exit already planned, That conversation starts before the application and not before the closing of your new loan. That, my friends, is it for the day. Please visit my website, billraponline.com. Would love to chat with you further about whatever you're facing. Have a good day.